In one of those interview questions and answers that have stayed with me for life, I asked then Reserve Bank of India Governor Y.V. Reddy who he visualized or thought of when formulating central bank policy. He responded promptly, the Aam Admi, the small guy or the average Joe, whoever or whatever you want to call it. There is an increasing or constant disconnect between what the regulators think and what mostly newer entrants in the banking or financial services space think that they're there for. Going by the reactions to the recent and fresh clampdown on non-bank finance companies, you would think that the Reserve Bank of India governor should first think of the life and fortunes of a venture capital firm parked in the Bay Area in California, trying to force create the next Apple Pay or something similar in India, after having either done something or failed trying to do the same thing in China. Or the Reserve Bank of India should perhaps think of the entrepreneur who sold that same dream sitting in Bangalore or thereabouts so that the company in question can comfortably proceed with a Series B or Series C fundraising round, or better still, dump the entire thing on some unsuspecting retail investor or investors, as some evidently already have. Now, why is the Reserve Bank of India acting so? The primary reason is the sheer growth of personal loans in the country and the mounting evidence that borrowers are using those loans for lifestyle reasons or to invest in various financial and non-financial instruments. So the top-down view tells us what is going on. For instance, credit card dues as of July 2024 were the fastest growing sector, accounting for over 1% of total bank loans, increasing 22% year on year to nearly 280,000 crores, according to a report in the Times of India on September 2nd. Loans against gold jewelry, however, grew the fastest within personal loans, growing almost 39%, according to that report. And that also added that personal loans were now capturing the largest share of non-food credit at about 33%, followed by services around 27%, among others. So according to the Reserve Bank of India's sectoral data on bank credit, personal loans grew by about 14.5%, reaching nearly 55 lakh crore rupees. Not surprisingly, the Reserve Bank of India is watching quite closely this segment, in addition to ringing periodic alarms as we've seen it. But the NBFCs in question would have you believe that they're being singled out. A collective and predictable wail went up when some parts of the community, as if the Reserve Bank of India's surveillance department got up on a Monday, discovered something was afoot, and sent out notices on Tuesday. Some pointed out that the crackdown would spell the death knell for the industry and there would be poor people who would be deprived of loan products they so desperately needed. It's actually quite the contrary, but that's a different discussion. The Reserve Bank of India said last week there were failures to adhere to the Fair Practices Code, improper income assessments, and neglect of borrowers' repayment capacities, particularly in the microfinance sector. I further quote the Reserve Bank of India, inspections revealed alarming practices, including evergreening of loans, questionable asset classification, and inadequate disclosures. All these were further compounded by outsourcing of core financial services. Of course, it was conveniently forgotten that the Reserve Bank of India said almost the same thing in June this year, when the governor warned NBFCs and microfinance institutions of charging usurious or unlawfully high interest rates. Now remember, many of these NBFCs are really shadow banks or essentially fronts for other mainstream banks, and then they take on the slick app-based selling and overselling to customers in the guise of customer acquisition and, of course, growth. If loans are a matter of a simple swipe on a smartphone, obviously more people will take them. It works like TikTok, which is considered to have the best or worst algorithms to keep you and your brains glued to the screen for the longest time possible. The difference here is, in addition to your brain matter, it's your savings that are getting drained out. There are a few larger issues. The Reserve Bank of India has been ringing the alarm bells on excessive small ticket loans for more than a year now. It's been specifically warning against small loans going into areas like stock market investing, including in more risky derivatives trading and other instruments like crypto. The governor said a few months ago, excess leverage through retail loans, mostly for consumption purposes, needs careful monitoring from a macro-prudential point of view. It calls for careful assessment and calibration of underwriting standards as well as post-sanction monitoring of such loans. Many of the people who take such loans are India's youth. So this is not just a business problem, but a social problem too. Because if it was a business problem, it would have been easier to address and solve. There is no doubt that the last 4 years or so has seen unprecedented growth in the consumer loan space. One could always argue that this is an outcome of overall economic growth, and there is some truth in that. But it's equally true that India is seeing levels of borrowing on one end and market speculation on the other that is quite disproportionate with many other economic indicators. Regulators have to be alert, or they will be hauled over the coals if it were to emerge that they were sleeping at the wheel. And there is little a regulator can do if companies who enter the space have a basic disconnect between their purpose. There is considerable potential for banking and banking financial services in India. Addressing this market in a commercially relevant way is important for economic growth and social progress. It's also important to understand who the consumer is. Why We Reddy statement is important to understand and digest, not just as an academic exercise, but while also framing business strategy.